Why do 90% of traders lose money before they even make their first profit? It is a shocking statistic that feels almost unreal, yet it is repeated across the world, across every market, and across every generation of traders. Some people will say it is bad luck, others will blame the market, and some will argue that only insiders and institutions can win. But the deeper truth, the truth that most people do not want to face, is that failure in trading has less to do with strategies or systems and far more to do with psychology. To understand why so many traders lose, imagine a flock of sheep being led by a shepherd. The sheep do not question where they are going, they simply follow. Step by step, blindly moving forward, each one trusting that the path will lead to food or safety. But what if that shepherd leads them towards a cliff? What if their trust, their blind following of the crowd, ends in destruction? This is exactly how most new traders enter the market. They follow the herd. They copy what others are doing. They chase after tips on social media, signals from strangers, and promises of easy money. They believe that if so many are rushing in the same direction, it must be the right path. But just like the sheep, they discover too late that the herd is heading towards disaster. Trading is not about following the crowd. It is about thinking differently. If you cannot stand apart, if you cannot resist the pull of the herd, then the market will chew you up and spit you out before you even see your first profit. And yet, despite this truth being known, thousands of new traders fall into the exact same trap every single day. They deposit their money, they open their first positions, and they are filled with excitement and hope. But beneath that excitement lies fear, greed, impatience, and a desperate need to be right. These emotions become their shepherd, leading them off the cliff without them even realizing it. Trading success is not just strategy, it is psychology. Anyone can learn a strategy. Anyone can watch a YouTube video, download an indicator, or copy someone else's system. But the reason only 10% survive is because the winners understand that strategy is only a small piece of the puzzle. The real battle is inside your own head. The market is a mirror that reflects your weaknesses. If you are impatient, the market will expose it. If you are greedy, the market will punish you. If you fear losing, the market will make sure you lose even more. Every trade is a test, not of your system, but of your discipline, your patience, and your ability to control yourself under pressure. Imagine this. A trader opens their very first account with 500. They have watched countless videos about turning small accounts into fortunes. They have seen screenshots of massive gains posted online. They believe they can double this money in a week. At first, they are cautious. They follow their plan. They make a few small wins. Confidence starts to grow. Then the first loss comes, and suddenly their emotions take control. Instead of accepting it and moving on, they try to win it back quickly. They double their position size. They trade without waiting for the right setup. They feel the heat in their chest, the racing of their heart, as the market moves against them. Within days, the account is gone. This is not bad luck. This is the psychology of almost every beginner trader. They come in with unrealistic expectations. They come in chasing the dream of fast riches. And because of that, they fall into the same cycle of overtrading, revenge trading, and blowing up their accounts. The herd mentality makes this worse. When they see everyone else on social media celebrating wins, they feel like they are missing out. They feel pressure to keep trading, to keep risking, to keep chasing. But what they don't see is that most of those people posting wins are hiding their losses, exaggerating their results, or just selling a fantasy. The herd does not think, the herd reacts, and reacting is death in the market. To survive, you must stop thinking like the crowd. You must stop chasing shortcuts. The true path to trading success is slow, patient, and often boring. It is not about excitement, it is about discipline. The market rewards consistency, not chaos. The best traders are not the ones who get lucky on one big trade, but the ones who can control themselves day after day, week after week, year after year. They understand that trading is a marathon, not a sprint. The problem is most traders treat it like a race. They want to get rich overnight. They cannot handle waiting. They cannot handle the grind. So they push harder, risk more, and burn out. This is why 90% fail. Not because they cannot learn a system, but because they cannot master themselves. Think of the market as a giant psychological trap. It tempts you with the possibility of freedom, wealth, and success. But at the same time, it constantly tests your weaknesses. Every flashing price, every sudden spike, every red candle is designed to provoke an emotional reaction. The market whispers in your ear, telling you to chase, to panic, to fear missing out. And if you listen, if you react, you lose. This is why trading feels so personal. Because every mistake is not just a technical mistake, it is a reflection of your own psychology. The market punishes impatience, greed, and fear, and rewards discipline, patience, and calm. Most traders never realize this. They spend years looking for the perfect system, hopping from strategy to strategy, thinking that if they just find the right indicator, everything will change. But the truth is, no strategy can save you if your mind is weak. You can hand the best trading plan in the world to a beginner, and they will still fail because they cannot execute it consistently. At the same time, you can give an average system to a disciplined trader, and they will succeed because they know how to manage risk, wait for opportunities, and control their emotions. This is the difference between the 90% who fail and the 10% who survive. The difference is not knowledge, it is discipline. The difference is not strategy, it is psychology. And until you understand that, you will remain part of the herd, blindly marching towards the cliff, following others into destruction. But once you see it, once you understand the trap, you can step away. You can choose not to follow the crowd. You can choose to think differently. And that choice is the first step towards becoming a trader who survives. In financial markets, one of the most powerful yet dangerous forces is herd behavior. Traders, whether beginners or sometimes even experienced ones, tend to move in groups, following signals, influencers, or what the crowd appears to be doing. At first glance, this seems irrational because markets reward independent thinking and punish predictability, yet time and time again people copy others, pile into the same trades, and end up experiencing the same losses. To understand why this happens, one has to look into psychology, fear, and the deeply rooted human instinct for safety in numbers. Since the earliest days of humanity, survival often depended on sticking with the group. A lone individual separated from the tribe was vulnerable to predators, hunger, and danger, but within the group, there was safety, food sharing, and strength. This instinct remains hardwired into human decision-making even today. When traders see a large group of people all rushing toward the same asset, whether it's Bitcoin, a meme stock, or a trending altcoin, they feel an almost unconscious pull to join in, fearing that if they do not, they might miss an opportunity or be left behind. This is the psychological need for safety in numbers applied to financial markets. Beginners are especially vulnerable to this pull because they often lack confidence in their own analysis. Without deep knowledge of market cycles, risk management, or chart reading, they search for external sources of certainty. Influencers on Twitter, YouTube, or TikTok appear to offer exactly that. These influencers project confidence, sometimes showing luxury lifestyles, screenshots of big wins, or carefully edited trading results. For a beginner who feels lost in the sea of candlesticks, trusting someone who looks like they know what they're doing feels safe. Similarly, Telegram and Discord trading groups give the illusion of community. People post signals like, "Buy now, target 10x," and when hundreds of others echo the same call, a new trader feels reassured that so many people cannot all be wrong. This is social proof bias, the tendency to assume that if many people believe something, it must be true. In reality, however, the crowd can be spectacularly wrong in markets because prices often move in the opposite direction of consensus. A perfect example of herd behavior gone wrong can be seen in the infamous Bitcoin pump groups that were common during bull runs. In these groups, organizers would secretly choose a coin and then at a scheduled time announce it as the next big pump. Members would rush in, buying within seconds, trying to front-run one another, while screenshots flooded the chat showing prices shooting up. Newcomers believed they had found a golden formula for making money: join the group, buy when the leader announces, and sell for instant profit. But in reality, the organizers and insiders were selling into that buying frenzy. They had already accumulated the coin cheaply beforehand, and as the unsuspecting masses piled in, the price spiked temporarily and then collapsed. Within minutes, sometimes even seconds, the market dumped and 90% of participants lost money. The sense of safety in numbers vanished and was replaced by regret and anger. Yet strangely, many victims came back again to try the same scheme, convinced that next time they would time it better. This cycle demonstrates how powerful FOMO, the fear of missing out, can be. Even after experiencing a loss, people are afraid that if they do not participate in the next pump, they will miss the one that finally delivers riches. FOMO is perhaps the single strongest fuel for herd trading. When prices rise quickly, charts circulate on social media showing parabolic gains, and everyone seems to be talking about the same asset. The mind begins to imagine a future where not joining means falling behind. Friends bragging about profits or influencers posting screenshots act as constant reminders of potential rewards. The pain of missing an opportunity feels worse than the risk of losing money, so people jump in late, right at the top, when the smart money is selling. This is why markets often peak with massive surges of new retail investors. They were watching from the sidelines but finally gave in when the pressure of missing out became unbearable. Social proof reinforces this. In psychology, Social proof is the phenomenon where people assume the actions of others reflect correct behavior. If 10,000 people on Twitter are tweeting about a stock, if Telegram groups are buzzing with buy calls, and if YouTube thumbnails all scream about the next 100x coin, a beginner interprets this as evidence of truth. It feels less risky to follow what everyone else is doing than to act alone. The crowd becomes a substitute for research, analysis, and conviction. Unfortunately, markets are structured in such a way that when the crowd agrees, the opportunity is usually already gone. Prices rise because buyers outweigh sellers, but once everyone has already bought, there are no new buyers left to push the price higher, and a reversal becomes inevitable. A famous modern case of herd behavior in trading is the Robinhood meme stock frenzy surrounding GameStop and AMC. In early 2021, a community of retail traders on Reddit's Wall Street Bets forum began encouraging each other to buy heavily shorted stocks. The idea was partly rebellion against hedge funds and partly greed for massive gains. The movement gained viral momentum with Twitter threads, TikTok videos, and mainstream media amplifying the hype. Suddenly, millions of ordinary people were downloading the Robinhood app and buying GameStop shares. The price skyrocketed from under $20 to nearly $500 within weeks. For many, the rationale was not about fundamentals or even strategy, it was simply because everyone else is buying. The herd mentality created a feedback loop. Rising prices attracted more buyers, which drove prices even higher, which in turn attracted more attention. People who had never traded before jumped in, convinced by the stories of overnight millionaires. But, as with all herd-driven manias, reality caught up. Brokerages restricted buying, volatility exploded, and latecomers who had bought near the top saw their positions collapse by 70 to 90%. Once again, the safety of numbers proved to be an illusion, and many who followed the herd were left with heavy losses. The irony is that while the instinct to follow the herd feels safe, in markets it often creates the opposite outcome. When everyone buys, liquidity dries up and prices collapse. When everyone sells in panic, that is often the bottom. Successful traders learn to resist this pull and instead cultivate independent thinking. They study market structure, risk management, and probability rather than relying on crowd signals. They recognize that fear and greed drive the masses and that true opportunity often lies in doing the opposite of what the herd is doing. But resisting herd behavior is extremely difficult because it requires not only going against external noise, but also battling internal emotions. Watching others celebrate profits while you stay on the sidelines feels painful. Choosing not to join a pump group feels like self-denial. Ignoring a viral stock feels like missing the party. Yet history shows repeatedly that the herd is rarely rewarded for long. To break free from herd mentality, a trader must first understand that markets thrive on exploiting human psychology. Whales, insiders, and institutions know how to use social proof and FOMO against retail traders. They deliberately create hype, spread signals, and amplify trends, only to sell into that buying pressure. Recognizing this dynamic is the first step to avoiding the trap. The second step is developing a personal framework for decision-making, clear rules for when to enter, when to exit, and how much risk to take. With a framework, the noise of the crowd becomes less influential because decisions are guided by logic rather than emotion. Over time, experience reinforces this independence. Traders begin to see that following the herd usually ends in regret, while patient, disciplined strategies yield more consistent results. Ultimately, the reason traders follow the herd is deeply human. It is not because they are foolish, but because evolution wired us to seek safety in groups. In everyday life, that instinct still serves us well. Most of the time we are better off trusting crowds, whether it is in choosing a restaurant with a long line or crossing the street when others move. But markets are not like ordinary life. In markets, the crowd is often the trap. The lessons of BTC pump groups, meme stock frenzies, and influencer-driven signals all point to the same truth. Herd behavior may feel safe in the moment, but in the long run it is one of the riskiest ways to trade. In the world of trading and investing, nothing is more persistent than the force of herd mentality. Time and again, crowds of traders make the same decisions at the same time, chasing the same stocks, cryptocurrencies, or commodities, and often suffering the same consequences. At first, this seems irrational, because financial markets should reward independent analysis and punish mindless imitation. Yet psychology and biology combine in ways that make herd behavior almost inevitable. To understand it, we must look at behavioral finance, the human brain, and the powerful emotional triggers that govern money decisions. One of the strongest psychological forces that drives herd behavior is loss aversion. Behavioral finance research shows that humans feel the pain of losing money about twice as strongly as they feel the joy of gaining the same amount. This imbalance makes traders desperate to avoid losses at any cost, and ironically, that desperation leads them into the arms of the herd. When people see others buying a rising asset, they fear being left behind and imagine that not joining could mean missing out on gains, which feels like a loss in itself. On the flip side, when markets fall sharply, the fear of losing more pushes people to sell just because they see everyone else selling, even if their rational brain knows panic selling is harmful. Loss aversion makes people hypersensitive to the actions of others, and instead of following their own strategy, they cling to the perceived safety of the crowd. Another force is confirmation bias, the tendency to seek out information that supports what we already want to believe while ignoring evidence that contradicts it. A trader who hopes that Bitcoin will double in price will eagerly consume bullish tweets, bullish YouTube videos, and bullish news headlines, while dismissing bearish analysis as fear-mongering. In herd trading, confirmation bias becomes a social amplifier. When many people with the same bias cluster together in online communities, they create an echo chamber that reinforces their collective belief. Everyone repeats the same arguments, retweets the same memes, and points to the same selective data, building a false sense of certainty. This explains why entire groups of retail traders can hold on to losing positions long past the point of rationality, convinced that the crowd cannot all be wrong, when in fact their shared confirmation bias is blinding them to reality. Overconfidence bias is another common driver. Most traders, especially beginners, overestimate their own ability to predict markets. They see a couple of small wins as proof of skill, when in reality those wins may have been luck. When this overconfidence combines with herd mentality, the danger multiplies. A trader not only believes in his or her own judgment, but also assumes that the crowd validates it. Together, these two factors create reckless conviction, leading to oversized positions, margin trading, or blind faith in trending assets. When the tide inevitably turns, that same overconfidence leads to devastating losses, because the trader cannot admit they were wrong until it is too late. Then there is panic selling, the emotional twin of FOMO. When prices suddenly crash, the brain's fear circuits fire intensely, activating the amygdala, the part of the brain that processes threats. Dopamine, which normally drives the excitement of gains, is replaced by cortisol, the stress hormone that floods the body during danger. Logic gives way to survival instinct, and traders sell everything in a desperate attempt to escape further pain. This phenomenon is what causes cascading crashes in markets. One person sells, another sees it and sells too, then algorithms trigger, stop losses activate, and within minutes the herd is stampeding out of the market. What began as a small drop snowballs into a full-blown collapse, not because of fundamentals, but because fear spread from one nervous trader to thousands. The biological basis of herd mentality is rooted in the brain's reward and fear systems. Trading taps into the same dopamine circuits that govern gambling and addiction. Each profitable trade releases a hit of dopamine, reinforcing the behavior and making the trader crave more. Watching green candles climb on a chart is intoxicating, like a slot machine hitting a jackpot. The brain remembers the thrill and wants to repeat it, which is why people chase pumps even when they know better. At the same time, the fear of losing money activates the brain's survival mechanisms. In evolutionary terms, missing out on food or resources was dangerous, so our brains evolved to respond strongly to potential loss. In markets, that translates into the pain of seeing others profit while we do not, or the terror of losing our savings in a crash. Dopamine pulls us toward the herd with promises of gain, while fear pushes us into the herd for protection from loss. Together, these two forces make herd behavior feel almost irresistible. A clear example of how this plays out can be seen in the way news cycles drive sudden surges of buying. Imagine a positive news story. A government announces a new policy favoring clean energy, and headlines proclaim that renewable stocks are the future. Instantly, news spreads across Twitter, financial news channels, and YouTube. Retail traders rush in, buying shares of solar or EV companies, convinced they are early to a big trend. But behind the scenes, market makers and institutional players anticipate this behavior. They accumulate positions before the news becomes public, then sell into the wave of retail buying. The herd feels euphoric, charts go vertical, and social media celebrates easy profits. Yet soon after, the momentum fades, prices reverse, and latecomers are trapped with heavy losses. The news acted as the trigger, the herd provided the buying pressure, and the professionals exploited both by unloading their positions at inflated prices. This cycle repeats endlessly, from tech bubbles to crypto manias, proving that herd behavior is not just psychological but also systematically used against retail traders. The most dangerous aspect of herd mentality is that it feels rational in the moment. When thousands of people are doing the same thing, when news anchors are celebrating the trend, and when your friends are making money, not joining feels foolish. Our brains equate consensus with truth, but in markets, consensus often marks the top. Legendary traders have long warned against this trap. Jesse Livermore, one of the greatest speculators of the early 20th century, observed that the market is never wrong, but opinions often are, and following the crowd leads to ruin. Warren Buffett distilled this wisdom into one of the most famous quotes in finance: "Be fearful when others are greedy, and greedy when others are fearful." This advice is the antidote to herd mentality. It means that when the crowd is euphoric and everyone is buying, danger is near. And when the crowd is panicking and everyone is selling, opportunity is present. The challenge, of course, is that going against the herd feels deeply uncomfortable. It requires suppressing instincts wired into human survival, resisting dopamine-fueled excitement, and enduring fear without acting on it. It requires independent thinking, patience, and a willingness to be wrong in the short term. But those who master this mindset separate themselves from the masses. Instead of being manipulated by news cycles, influencers, or the adrenaline of the crowd, they develop their own frameworks, grounded in discipline and risk management. They understand that herd mentality is a powerful force, but one that can be anticipated, observed, and even profited from, rather than blindly followed. In the end, herd mentality is not just a flaw in human psychology, it is the natural outcome of evolution, biology, and emotion colliding with the uncertainty of markets. Loss aversion makes us fear missing out or losing too much. Confirmation bias blinds us to contrary evidence. Overconfidence convinces us we are right, and panic selling drives us to act without thought. Dopamine fuels the highs, fear drives the lows, and the news cycle acts as the spark that ignites the crowd. The result is a recurring pattern of manias and crashes that have defined financial history for centuries. For the trader who wants to survive and thrive, the lesson is clear: learn to recognize the herd, resist its pull, and remember the wisdom of Buffett. Be fearful when others are greedy, and greedy when others are fearful. Financial history is filled with stories of markets rising to unbelievable heights and then collapsing just as dramatically, and at the center of every major boom and bust lies the same force: herd mentality. Investors, large and small, often convince themselves that following the crowd guarantees safety and profit, but time and again the opposite proves true. The herd tends to buy when prices are already inflated and panic sell when markets bottom out, creating cycles of euphoria and devastation. To understand how dangerous this instinct can be, one only needs to look at some of the most famous examples: the dot-com bubble of the late 1990s, the housing bubble of 2008, and the crypto boom and crash of 2021 to 2022. Each of these episodes shows how herd behavior leads millions into the same trap, how charts reveal the pattern of entries at the very top and exits at the very bottom, and how individual traders and investors paid the ultimate price for blindly following hype. The dot-com bubble is one of the clearest examples of herd failure. In the mid to late 1990s, the internet was emerging as a revolutionary technology, and investors became convinced that any company with a .com in its name was destined for success. Stock valuations skyrocketed, not because of profits or revenue, but because of dreams about the future. Companies with no earnings, no viable business models, and sometimes no real products raised millions simply by attaching themselves to the internet boom. The media fueled the frenzy, broadcasting stories of overnight millionaires and predicting a new economy where traditional rules no longer applied. Ordinary people, watching neighbors and colleagues get rich, felt compelled to join in. They opened brokerage accounts, mortgaged homes, and poured savings into tech stocks, convinced that the crowd could not be wrong. Charts from that era tell the story clearly. The Nasdaq index surged to an all-time high in early 2000, reflecting the stampede of buying, but when reality set in, the bubble burst. Within 2 years, trillions of dollars of market value were wiped out, and the Nasdaq lost nearly 80% of its value. The herd had bought at the top, when excitement was greatest, and sold in despair at the bottom, when opportunity was actually strongest. For many individuals, this was not just a lesson in markets but a life-changing financial disaster. Stories abound of small investors who lost retirement savings, students who invested loan money in internet stocks, and professionals who thought they were riding the future only to be left with worthless shares. The herd mentality that promised safety left them with ruin. A similar story unfolded less than a decade later in the 2008 housing bubble. This time, the asset was not tech stocks but real estate, something people considered even safer because it was tangible. For years, property prices had risen steadily, and a narrative took hold that housing always goes up. Banks offered easy credit, subprime mortgages flourished, and television shows glamorized flipping houses as a path to quick wealth. Herd mentality gripped not just traders but entire societies. Everyone from Wall Street professionals to ordinary families believed they had to buy property or risk being priced out forever. Charts of housing prices in the mid-2000s show the same pattern of acceleration, with demand surging even as affordability fell. The frenzy was amplified by confirmation bias, as people saw others making money and assumed they must join in. Those who hesitated were ridiculed for not taking advantage of the boom. But just like the dot-com bubble, the housing mania collapsed. When mortgage defaults began rising and credit markets froze, the illusion shattered. Home prices fell dramatically, financial institutions failed, and the global economy plunged into crisis. Once again, the herd that had rushed in at the peak now rushed out in panic, selling homes at losses, abandoning properties, or being foreclosed upon. The idea that real estate was immune to bubbles proved false, and countless families and investors were left devastated. Stories from this period include individuals who owned multiple properties with little equity, convinced they were financial geniuses, only to lose everything when the market turned. Herd mentality had turned housing from a secure asset into a speculative bubble that brought the world to its knees. Fast forward to 2021, and the same psychology played out in the world of cryptocurrency. After a massive run-up in 2020, Bitcoin, Ethereum, and countless altcoins began climbing to new all-time highs in 2021. Social media amplified every move, with Twitter, TikTok, and YouTube flooded by influencers predicting 10x or 100x gains. Meme coins like Dogecoin and Shiba Inu soared not because of fundamentals, but because the herd believed they could not lose as long as everyone kept buying. Retail traders, many with little experience, poured money into the market at the peak, driven by stories of overnight millionaires. Celebrities endorsed coins, mainstream news ran stories about unstoppable crypto wealth, and platforms like Coinbase made entry easier than ever. Charts from this period show the same vertical climb near the top, as euphoric buying overwhelmed caution. But in late 2021 and into 2022, the bubble burst. Prices of major cryptocurrencies collapsed by more than 70%, and many smaller tokens lost over 90% of their value. Projects once hailed as the future vanished overnight. The herd that had been ecstatic at the top now panicked sold at the bottom, locking in catastrophic losses. Individual stories from this period capture the human cost. Young traders who had turned small investments into six figures by sheer luck refused to sell, convinced by online communities to ODL forever, only to watch their portfolios evaporate. Some borrowed money to buy more at the top, thinking they were securing generational wealth, but instead found themselves with crushing debt and worthless coins. Others sold everything in despair at the bottom, unable to bear the constant stress, only to see prices recover slightly after they had exited. The emotional roller coaster of dopamine-driven gains and fear-driven losses created lasting scars. Herd mentality once again lured countless people into the trap of buying high and selling low. What makes these bubbles so striking is how similar the charts look despite being in completely different markets. Whether in tech stocks in 2000, housing in 2008, or crypto in 2021, the herd consistently entered as prices soared near all-time highs and exited in panic near the lows. Peaks are defined by mass euphoria, endless positive news, and the belief that the old rules no longer apply. Bottoms are defined by despair, widespread selling, and the conviction that the asset will never recover. Yet in hindsight, the top always looks obvious, and the bottom always looks like opportunity. This contrast shows that herd behavior is not about logic but about emotion. Safety feels like being with the crowd, even when the crowd is marching toward disaster. The many stories of individuals add flesh to this pattern. Consider the worker in 1999 who cashed out retirement savings to buy shares in Pets.com, thinking it was the future of retail, only to watch the stock go to zero within months. Or the family in 2006 who bought multiple properties with adjustable-rate mortgages, expecting endless appreciation, only to lose everything when payments reset and the market collapsed. Or the college student in 2021 who put all of his savings into a meme coin because of TikTok hype, briefly saw it multiply tenfold, but refused to sell, and ended up with almost nothing when the bubble burst. These are not isolated mistakes but reflections of a universal tendency to follow the herd. The tragedies feel personal, but the underlying psychology is collective. What ties all these cases together is the illusion of safety. People believe that if everyone is doing the same thing, it must be correct. The media, influencers, and peers reinforce the belief, creating an echo chamber of certainty. Yet markets reward contrarian thinking, not consensus. The great investors who navigated these bubbles successfully did so by resisting the herd, selling when others were euphoric and buying when others were panicking. The lesson from history is clear. Herd mentality may feel safe in the moment, but over time it proves to be the most dangerous strategy of all. In trading, the biggest battle is not with the market but with your own mind. Charts, indicators, and strategies are tools, but the real edge comes from psychology. Most traders lose not because they lack knowledge, but because they get trapped inside the same herd mentality that has destroyed fortunes for centuries. To escape this cycle, you need a mindset framework that allows you to act rationally when others act emotionally. This framework can be broken into 4 essential steps: independent thinking, risk management first, delayed reaction, and long-term vision. Together, these steps form a protective shield against the constant noise of the crowd. Independent thinking is the first and most important step. Herd mentality thrives on blind trust. Most beginners copy influencers, Twitter signals, or Telegram groups because it feels safe to follow someone louder and more confident. But what feels safe is often the riskiest thing you can do. Independent thinking means you do not accept information at face value. Every signal, every news headline, every YouTube prediction has to be questioned. Who benefits from me believing this? Is the data reliable, or is it simply designed to create hype? In 2021, when altcoins were promoted daily as 100x gems, countless traders piled in without asking these questions. By the time retail buyers rushed in, insiders had already bought low and were waiting to sell into the frenzy. The independent thinkers who slowed down and asked the right questions either stayed out or waited for a better entry. Warren Buffett once said, "You are neither right nor wrong because the crowd disagrees with you. You are right because your facts are right and your reasoning is right." That is the essence of independent thinking. The herd listens, the disciplined trader investigates. The second step is risk management first. Most traders dream of profits and ignore the possibility of losses until it is too late. The herd mentality encourages this mistake, because when everyone else is betting big, it feels weak to play small. But real strength comes from protecting your capital. Risk management means controlling how much of your account you expose on each trade, using stop losses to protect against disaster, and prioritizing survival over hitting a jackpot. Imagine 2 traders entering the same meme stock. The herd follower risks 80% of their account because this is the big one. The independent trader risks just 2%. If the trade goes wrong, the first trader is wiped out while the second trader shrugs, learns, and moves on. The difference is not strategy but mindset. Risk management is the discipline that separates gambling from professional trading. It allows you to stay in the game long enough for skill and knowledge to compound. Without it, you are chained to the fate of the crowd. With it, you have the freedom to grow even while being wrong more often than right. The third step is delayed reaction. The herd reacts instantly. A coin pumps, and within seconds, thousands of retail traders rush in with FOMO, believing they will miss the opportunity of a lifetime. But the market is designed to punish impatience. Very often, the first wave of hype is where retail enters, and the second wave is where smart money exits. Delayed reaction is the art of waiting. Instead of chasing a spike, you pause and ask, is this sustainable? Has the news already been priced in? Am I entering because of logic or because of emotion? The truth is that opportunities are infinite, but capital is not. Missing one trade does not matter. Destroying your account does. Consider the GameStop frenzy of 2021. Many traders clicked buy within seconds of seeing Twitter trends. Some made a fortune, but the vast majority bought at inflated prices and sold during the crash. The herd moved instantly. Independent traders paused, analyzed, and either entered early with discipline or avoided the madness altogether. By practicing delayed reaction, you inoculate yourself against FOMO. You learn that sometimes the best decision is to do nothing at all. The fourth and final step is long-term vision. Herd mentality thrives on short-term gratification. Everyone wants quick profits today, even if it means massive losses tomorrow. Long-term vision flips this script. It forces you to prioritize consistency, compounding, and growth over years, not minutes. The best traders and investors think like farmers, not gamblers. They plant seeds, nurture them, and wait patiently for the harvest. The herd wants fast food. The disciplined trader cooks at home, knowing it takes time to prepare something nourishing. With a long-term vision, you stop panicking over every dip and spike. A gambler sees a 10% drop and panics. An investor sees the same drop as a discount. Long-term vision also brings emotional stability, because when you zoom out, short-term volatility loses its power to scare you. Buffett captured this mindset perfectly when he said, "Be fearful when others are greedy, and greedy when others are fearful." The herd moves with emotion. The disciplined trader moves with perspective. This entire framework can be summed up in a simple analogy. The herd is like a crowd rushing into a fast food restaurant because the sign says, "Limited time only." The bright lights and urgency pull them in, and they feel satisfied in the moment, but regret it afterwards, bloated, unhealthy, and unsatisfied. The top trader, however, is like the person who walks past, goes home, and carefully prepares a healthy meal. It takes more effort, it takes patience, but in the long run, that meal builds real strength and health. Trading is the same. Herd mentality offers instant gratification but long-term regret. Independent thinking, risk management, delayed reaction, and long-term vision take more discipline, but they lead to sustainable success. Breaking free from herd mentality does not mean always doing the opposite of the crowd. It means developing a framework that keeps you rational when others are emotional, disciplined when others are reckless, and patient when others are desperate. The 4 steps: independent thinking, risk management first, delayed reaction, and long-term vision act as a compass. They turn trading from gambling into a professional craft. Every trader must make a choice: follow the herd into the same traps that have ruined countless accounts, or step aside, cook your own meal, and build something lasting. The herd is noisy, but true mastery is silent, steady, and deeply rewarding. Every trader begins with dreams of freedom, wealth, and mastery over the market, but very few manage to build the kind of discipline required to actually reach those goals. The market is a battlefield designed to prey on emotions, and the undisciplined trader quickly finds themselves pulled in by greed when prices rise and crushed by fear when they fall. If you study those who last in this game, you will notice that their success is not built on secret indicators or magic formulas, but on routines that protect them from their own impulses. A disciplined trader does not just wake up and hope for the best. They follow a roadmap, one that begins with the way they start their day, continues with the way they plan and execute trades, and extends into how they review and reset themselves weekly and monthly. This roadmap becomes a shield against chaos, and it is the foundation that allows them to survive and compound while others are wiped out. The routine begins long before charts or news are opened. The first step is a morning mindset check, because trading is not just numbers on a screen. It is the constant battle between rational analysis and emotional reaction. The disciplined trader starts by journaling. A blank page becomes a mirror where thoughts and emotions are poured out. They might write about how they feel waking up, restless, anxious, overconfident, or calm. They then write down affirmations, not vague motivational quotes but direct reminders that shape their decisions later in the day. A trader might write, "I will not chase signals today, only my setups matter." Another might write, "Losses are tuition, not punishment." These affirmations seem simple, but they carry power. Neuroscience shows that writing reduces emotional charge by shifting activity from the reactive amygdala to the logical prefrontal cortex. In other words, journaling turns raw emotion into structured thought. It is the difference between being controlled by fear unconsciously and recognizing fear consciously. That recognition weakens its grip. To understand the importance of this, picture 2 traders. One wakes up, checks Twitter, sees people screaming about a stock going to the moon, and immediately feels left behind. Without reflection, he rushes into the market unprepared, already emotionally hijacked. The other wakes up, journals, and notices he feels impatient. By identifying it early, he can adjust expectations for the day, reminding himself not to force trades. Both traders face the same market, but their outcomes diverge dramatically because one prepared his mind while the other let the noise take over. After journaling, the disciplined trader moves to pre-market analysis. This is not about chasing the latest headline or copying influencers, but about independently applying their system. They scan charts calmly, mark potential levels, and prepare scenarios. For example, they might note, if price approaches this support zone with rising volume, I will consider entering long, or, if volatility spikes after open, I will sit out until conditions stabilize. The analysis is written down, not just held in the head, because writing creates accountability. Importantly, risk parameters are set before the first trade is taken. Maximum position size, stop-loss levels, and daily drawdown limits are all defined in advance. This is like a pilot checking instruments before flight. No matter how confident they feel, the checklist protects against disaster. A disciplined trader knows that risk management is not a backup plan, it is the plan. They accept that losses are inevitable but catastrophic losses are preventable, and that prevention is their responsibility. Contrast this with the undisciplined trader who wakes up, sees breaking news, and jumps in with oversized positions. Their plan is reactive, built in the heat of the moment, and risk is decided emotionally. When things go against them, they are shocked, angry, and confused, but the truth is they never had a plan in the first place. This is why preparation is so powerful. It transforms randomness into structured probability. Once the market opens, emotions run wild. Green candles spark greed, red candles trigger fear, and volatility creates the illusion of opportunity everywhere. The disciplined trader leans on their journal as a companion during this chaos. Each trade is recorded, not just the technical entry and exit, but the emotional state behind it. A journal entry might read, Entered long at 4,500 due to support zone confirmation, feeling calm and focused. Another might read, exited early at 45.20 due to fear of losing profit. Even though plan was to hold until 45.50, over weeks and months these notes become data and data reveals patterns. Perhaps the trader notices that early exits cost more than initial losses, or that most bad trades happen in the first 30 minutes of open. These insights are invisible without a journal, but with one, they shine brightly, showing where discipline needs reinforcement. The journal becomes both coach and therapist, teaching lessons that no textbook can. The day ends not with random relief or despair but with documentation. A disciplined trader does not close the platform and forget, they reflect briefly. Did I follow my plan? Did I let emotions push me around? This short reflection closes the day with awareness, ensuring that tomorrow begins with context, not confusion. When days stack into weeks, the roadmap zooms out into the weekly process. The weekly review is a deliberate practice of analyzing not just results but behaviors. A trader sits down with their journal and trade log, asking honest questions. Did I size trades correctly? Did I take setups that matched my rules or did I improvise? Were my losses the result of bad analysis or broken discipline? Did greed or fear dominate? This is like an athlete reviewing game footage or a musician listening to recordings of their own practice. The goal is not to shame but to identify patterns and refine performance. Maybe the trader realizes that 3 losing days in a row led to frustration and rule breaking, or they notice that profits came only from a specific setup, while all improvisations lost. These realizations allow them to tighten discipline, reducing leaks in their system. A 1% improvement weekly compounds into massive growth over months and years. At the end of each month, the trader performs a deeper mindset reset. This is not just reviewing trades but reflecting on the emotional and psychological journey of the past 4 weeks. They might write, after a winning streak in the second week, I felt invincible and doubled risk, leading to bigger losses. Or, fear after early losses kept me from taking valid setups in the final week. This reflection keeps emotions from becoming invisible saboteurs. The monthly reset also includes revisiting the trading plan itself. Strategies evolve as markets change, and this is the time to refine rules, test new approaches, or eliminate ones that are underperforming. Importantly, changes are documented. The plan evolves deliberately, not reactively. This reset also reconnects the trader with their long-term vision. Why am I trading? To chase quick thrills or to build long-term independence? By asking these questions monthly, the trader avoids drifting into gambling disguised as trading. To make all of this practical, worksheets and templates become vital. A daily worksheet might include 3 affirmations at the top, a section to record emotional state, and space to write down pre-market setups and risk limits. The trade log template could have columns for entry, exit, reason, risk, and emotion. The weekly review sheet might have questions like, what mistake repeated this week? And, what will I do differently next week? The monthly reset worksheet could ask, which emotion dominated this month? How did I respond to winning streaks or losing streaks? What system adjustments will I test next month? These templates turn vague reflection into measurable practice. Over time, the stack of completed worksheets becomes a personal textbook of trading psychology, showing growth and revealing blind spots. Consider the analogy of cooking versus fast food. Most traders chase signals and quick profits like people rushing to grab fast food. Cheap, fast, and instantly gratifying but unhealthy and unsustainable. Disciplined traders, however, cook their own meals. It takes time, effort, and patience, but it nourishes them long term. The roadmap of journaling, preparation, and reflection is their recipe. It may not feel exciting, but it produces lasting results. Another analogy is the pilot checklist. A pilot does not rely on mood or instinct before takeoff. They go through each item carefully because lives are at stake. A trader's capital and future are at stake, and the same seriousness must be applied. Athletes too follow strict routines, warm-ups, drills, video reviews, not because they enjoy repetition but because repetition builds mastery. The trader who builds routines is no different. Real-world stories confirm this. During the crypto boom of 2021, millions bought coins at all-time highs because influencers shouted this is the future. Many saw their portfolios crash by 70–80% in 2022. They had no plan, no journal, no risk management, just hope. Meanwhile, disciplined traders risked small portions, journaled each decision, and preserved capital. They still lost trades, but they survived. Survival allowed them to re-enter when markets stabilized, while the herd was wiped out. This survival was not luck, it was the fruit of discipline. The disciplined roadmap may sound boring compared to hype and adrenaline, but its power lies in consistency. Every day begins with mindset journaling, affirmations, and awareness. Every day includes independent pre-market analysis and risk planning. Every trade is documented, every week is reviewed, and every month is reset. This structure may feel restrictive at first, but over time it creates freedom. A trader who journals is free from denial. A trader who plans risk is free from disaster. A trader who reviews is free from repeating mistakes. A trader who resets monthly is free from drifting. True freedom is not the absence of rules but the presence of the right ones. Over months and years, this routine transforms a trader. They no longer feel the need to chase every move because they trust their system. They no longer panic at losses because they expect and manage them. They no longer get drunk on wins because they review with humility. They build patience, clarity, and resilience. This is the difference between a gambler and a professional. One chases highs, the other builds foundations. One burns out, the other compounds. Trading mastery is not about knowing the future, it is about knowing yourself. The market will always be uncertain, volatile, and manipulated, but your discipline can be certain, stable, and strong. By following this roadmap, morning mindset checks, pre-market analysis, journaling trades, weekly reviews, and monthly resets, you create order in the middle of chaos. You cannot control the market, but you can control yourself. And in trading, controlling yourself is the only edge that lasts. The herd will always rush toward noise and hype, but the disciplined trader, walking steadily with structure, will always outlast them. The roadmap is not easy, but it is the path. It is how ordinary traders become extraordinary over time, not by predicting markets but by mastering themselves. Every trader begins their journey hoping to find a system or strategy that will guarantee profits. They spend hours searching for the perfect indicator, the flawless chart pattern, or the hidden piece of insider information that will finally unlock the secret to consistent success. But those who last in the game long enough eventually discover a truth that feels almost counterintuitive. The real secret is not in the charts, not in the news, and not in the indicators. The real secret is in the mind. Trading is 20% technical knowledge and 80% psychology. The market does not just test your analysis, it tests your patience, your discipline, and your emotional control. If your psychology is weak, even the best system will fail you. But if your psychology is strong, even an average system can make you profitable over time. In this script, we will uncover 7 professional tips and hidden psychological hacks that disciplined traders use to gain an edge. These are not superficial tricks, but deep practices rooted in philosophy, psychology, and performance science. We will draw on the wisdom of Stoic philosophers, the visualization techniques of elite athletes, the mindfulness habits of professionals, and the mindset shifts that allow traders to rise above the noise of the crowd. Together, these hacks form a toolkit for mastering yourself in the unpredictable world of trading. The first and most powerful foundation comes from Stoic philosophy. 2,000 years ago, Stoic thinkers like Marcus Aurelius, Seneca, and Epictetus taught that we should focus only on what we can control and accept what we cannot. This wisdom applies perfectly to trading. You cannot control whether the market goes up or down. You cannot control the next candle or the next news headline, but you can control your preparation, your risk, and your reaction. The Stoics practiced negative visualization, the act of imagining loss before it happens. Instead of being shocked when setbacks occur, they are prepared. A trader who adopts this mindset is not blindsided by a losing trade. They have already accepted the possibility before entering. This reduces emotional shock and prevents panic. Imagine 2 traders. One enters a position believing it must succeed, and when it fails, he feels devastated and betrayed. The other enters knowing it could fail, already at peace with the risk, and when it does fail, he shrugs and moves on. The same loss, but 2 entirely different outcomes. That is the power of Stoic preparation. A practical hack is to deliberately visualize your trade failing before you place it. Ask yourself, if I take this trade and it hits my stop loss, will I be calm enough to move on? Or will it shake me? If the thought of losing fills you with fear, you are risking too much. If you can calmly accept the outcome, you are trading within your true limits. This one exercise can transform how you size positions and how you handle inevitable losses. It rewires your brain to treat losses as part of the game rather than personal failures. The second hack draws inspiration from the world of sports psychology. Athletes at the highest level, Olympic runners, championship boxers, world-class golfers, use visualization to prepare for peak performance. They do not just train physically, they mentally rehearse success. A sprinter visualizes exploding off the blocks, each stride smooth and powerful, crossing the finish line first. A golfer visualizes the ball arcing through the air and landing on the green. This is not daydreaming, it is a proven method to activate the same neural pathways that physical practice does. Traders can use the same tool. Before the trading session, close your eyes and visualize yourself executing your setups flawlessly. See yourself waiting patiently, see yourself clicking buy or sell calmly, and see yourself closing the trade according to plan, win or lose. Visualize yourself journaling afterward with discipline. This mental rehearsal builds confidence and reduces hesitation. When the real moment arrives, your brain feels like it has already been there, and execution becomes smoother. Visualization also helps with recovery. If you end a day in loss, instead of obsessing about what went wrong, visualize tomorrow's routine unfolding with focus and calm. By practicing success in your mind, you create a self-fulfilling prophecy. The opposite is also true. If you constantly imagine failure, panic, and regret, your mind will create those outcomes. Visualization is a hidden hack because most traders never bother with it, but those who do gain a professional edge. The third hack involves the breath. Breathing is often overlooked, but it is the fastest way to influence the nervous system. When you lose a trade, your body reacts as if under threat. Heart races, cortisol floods your system, palms sweat, mind narrows. This is the fight or flight response, designed for survival but destructive for trading. Professional traders use breathing techniques to reset themselves. One simple method is the 4-7-8 technique. Inhale deeply for 4 seconds, hold for 7, exhale slowly for 8. This slows the heart rate, signals safety to the brain and restores clarity. Another method is box breathing. Inhale for 4, hold for 4, exhale for 4, hold for 4. This creates balance and focus. Meditation builds on this foundation, training the mind to observe thoughts without attachment. By practicing 10 minutes of mindful breathing daily, traders learn to detach from emotions in real time. Instead of being swept away by fear or greed, they can observe it rising, acknowledge it, and let it pass without reacting impulsively. Consider how a fighter pilot handles extreme stress. They cannot afford to panic when missiles are locked onto their jet. They rely on training, calm breathing, and detachment. A trader, though not in physical danger, faces psychological stress that feels just as intense. By using breath and mindfulness, they build the same resilience under pressure. The fourth hack is detachment from results. Most traders obsess over individual trades, as if each one defines them. This is like a poker player panicking over every single hand instead of playing the long game. Professionals know that one trade means nothing. What matters is the series, the process, the probabilities. By detaching from the outcome of a single trade, you protect your mind from emotional extremes. You are neither euphoric when you win nor devastated when you lose. You simply log the trade and move on. Detachment does not mean apathy, it means valuing discipline over short-term results. A helpful mantra is, I am not my trades, I am my process. By repeating this, traders train themselves to focus on execution, not outcome. Over time, this detachment builds emotional stability. The fifth hack is to use fear as a compass rather than an enemy. In most people, fear paralyzes, but professionals reinterpret it. If you feel fear because you are risking money you cannot afford, that is a signal to reduce size. If you feel fear before entering a valid setup, that may be the precise signal that the trade is worth taking. Growth in any field lies just beyond fear. By journaling about fear and reframing it, traders can transform it into guidance. Stoics called this practice turning the obstacle into the way. What frightens you can teach you. The sixth hack is to shift identity. Instead of seeing yourself as a retail trader chasing money, adopt the identity of a professional risk manager. Professionals are not in the business of winning every trade, they are in the business of managing risk and letting probabilities play out. By shifting identity, your behavior changes. If you see yourself as a gambler, you will act like one. If you see yourself as a risk manager, you will respect stops, plan carefully, and remain patient. Identity shapes action more powerfully than willpower. Finally, the seventh hack is perhaps the most secret. Follow data, not the crowd. The herd is always noisy. Twitter screams about moonshots, Telegram groups pump coins, mainstream media dramatizes every move. But crowd opinion is unreliable. Professionals detach from it and rely on data. They track their own win rates, expectancy, average risk to reward, and emotional triggers. They build personal dashboards of performance. This data becomes their compass. When the crowd panics, they remain calm because the numbers guide them. When the crowd chases, they wait because probabilities matter more than hype. Following data also means trusting backtesting, forward testing, and journaling instead of rumors and excitement. This is the true hidden hack. Your edge comes not from knowing what others think, but from knowing your own numbers. To integrate these hacks, traders can create simple daily rituals. Begin with Stoic journaling. Write down what is within your control today and what is not. Then practice visualization. See yourself executing flawlessly. Before the session, take 3 rounds of deep breathing to center yourself. During trading, remind yourself, I am not my trades, I am my process. After each trade, log it and detach. At the end of the week, Review fear moments and reframe them as lessons. Monthly, analyze your data and refine your plan. These rituals turn abstract hacks into concrete habits. The greatest traders are not fortune tellers, they are masters of themselves. They embrace stoic wisdom to accept losses. They visualize success like athletes. They regulate their nervous system with breathing and meditation. They detach from individual outcomes and trust the long-term process. They reframe fear into guidance. They shape identity as professionals. And above all, they follow their own data instead of the noisy crowd. These are the hidden psychological hacks that separate amateurs from professionals. If you commit to practicing even half of these techniques, you will notice a transformation. You will no longer be thrown around by every market move. You will no longer feel addicted to chasing hype. You will find yourself calmer, clearer, and more consistent. And consistency, not brilliance, is the true path to trading mastery. In the end, markets will always be uncertain, but your mind does not have to be. By mastering yourself, you unlock the only edge that lasts: discipline. Every trader at some point feels the powerful pull of the herd. It is deeply human. We are social creatures wired for survival in groups. When everyone around us is rushing in one direction, the instinct is to follow. In the wild, that instinct kept our ancestors alive. If the tribe ran from danger, the one who stopped to question got left behind. In markets, however, this instinct betrays us. What feels safe often turns out to be the most dangerous place. When everyone is buying the same stock, hyping the same coin, or shouting about the same trade, it often means the opportunity is already gone. The market punishes the crowd, but rewards the patient. This is the mantra you must carry forward. The market punishes the crowd, but rewards the patient. Repeat it until it becomes second nature. In trading, being early or being late because of the herd are both costly mistakes. The crowd buys at tops and sells at bottoms. The disciplined trader, on the other hand, waits for opportunity, ignores noise, and accepts that being contrarian sometimes feels uncomfortable. That discomfort is the price of true independence. Think of the trader who learns this lesson the hard way. In the beginning, he follows every signal group, every social media tip, every guaranteed strategy whispered in forums. Sometimes he makes money, but most of the time he gives it back. He feels confused because the crowd always seems so confident. How could thousands of people all be wrong? Yet over and over, he notices the same outcome. He buys when everyone is screaming bullish and the market crashes. He sells when fear dominates and the market rebounds. Slowly, painfully, he realizes the truth. Following the herd is the fastest road to destruction. Now picture the turning point. One day, after another painful loss, he sits down and promises himself that he will no longer be part of the 90% who lose by chasing others. He begins journaling his own thoughts, analyzing his own trades, and building his own framework. At first it is hard. Doubt creeps in. He sees others making money in meme coins or hype trades while he sits patiently on the sidelines. But he reminds himself of the mantra: the market punishes the crowd, but rewards the patient. Slowly he sees the difference. Where before he jumped impulsively, now he waits. Where before he risked too much, now he manages position size. Where before he panicked, now he breathes and detaches. His results start to shift. No longer is he chasing crumbs, he is building consistency. This transformation is not dramatic like in a movie. There is no overnight success, but it is steady, real, and lasting. He is no longer at the mercy of crowd emotions. He has stepped outside the herd. Over time, he compounds not just money but confidence, clarity, and peace of mind. He has joined the minority of traders who trade less, think more, and win slowly. And winning slowly is the only way to win sustainably. This is the story you must carry with you. It is not just about charts or candlesticks. It is about discipline, patience, and mindset. The herd will always exist. There will always be noise, hype, fear, and frenzy. You cannot silence it, but you can decide not to be part of it. You can choose to act differently, and in that choice lies your edge. If you take only one thing from this entire journey, let it be this: herd mentality is natural, but success in trading requires contrarian discipline. Write it down. Put it on your wall. Whisper it to yourself before every session. Because in the heat of the market, when your screen is flashing and emotions run high, you will need a simple anchor. And this is it: the market punishes the crowd, but rewards the patient. Do not underestimate how powerful this shift is. It may seem small, like just a sentence, but it is the kind of sentence that can save you from years of mistakes, from countless unnecessary losses, from the endless trap of chasing others. It is the kind of sentence that turns an impulsive gambler into a disciplined trader. And now comes the call to action. Do not be in the 90%. Do not spend your life handing money to the market because you could not resist the herd. You are better than that. If this message has spoken to you, if it has lit even a small spark inside, then protect that spark. Nurture it with practice, with patience, with discipline, and do not keep it to yourself. Share it with someone who needs this truth, because the world is full of traders repeating the same cycle of hype and regret. Maybe your sharing will be the wake-up call they need. Maybe it will save them years of pain. This is how movements start, not by masses charging blindly together, but by individuals breaking away, finding clarity, and inspiring others to do the same. You now stand at a crossroads. One path is wide and crowded, filled with noise, excitement, and eventual ruin. The other is narrow, quiet, sometimes lonely, but it leads to mastery and freedom. Which path will you choose? Remember the mantra one final time: the market punishes the crowd, but rewards the patient. Carry it with you, live it in your actions, and let it guide you out of the herd into the small circle of those who trade with discipline. Your future as a trader does not depend on predicting the market, it depends on mastering yourself. The herd will always exist, but you no longer have to be part of it.